Good afternoon, everyone. My name is Venkateswaran, and I'm delighted to welcome you all to the 27th NYU Stern Economic and Market Outlook Forum. The host of today's forum is the Stern Center for Global Economy and Business, which serves the university through outreach to the broader community, including the academic, business, and policy worlds, as well as our students and alumni. We are pleased today to have in the audience students and faculty from all over NYU, as well as many alums. And thank you all very much for joining us. Today's session will last about 90 minutes. It'll begin with short presentations by each of the panelists about their economic and market outlook, followed by audience Q&A. We'll finish by 6:30 p.m. To ask questions, please enter them through the Q&A feature in Zoom. In moderating the sessions, I'll try to limit repetition by grouping similar questions or questions on the same themes together. Given the time constraints, we may not be able to get to all the questions. My apologies in advance. I'll now briefly introduce our distinguished panelists in alphabetical order. Our first panelist is Aditya Bhave, who's Managing Director and Senior U.S. Economist at Bank of America Securities. He focuses on the U.S. consumer and contributes to the widely read BofA on USA report, as well as other thematic research. Aditya also helps formulate the team's views on inflation, growth, and monetary policy. Previously, he was a U.S. economist and rate strategist at Deutsche Bank. He has a PhD in economics from the University of Chicago and a bachelor's degree in economics and math from Amherst College. Welcome, Aditya. Our second panelist is Tani Fukui, who is economist and senior director of global economic and market strategy at Metlife Investment Management. She conducts macroeconomic research and provides forecasts for Metlife and the clients of Metlife Investment Management. She's been with Metlife since 2015. Prior to that, she worked at the U.S. International Trade Commission, analyzing the economic effects of trade policy. She holds a BSc in finance from the Wharton School, an MA from Columbia, and a PhD in economics from UCLA. Welcome, Tani. Our third panelist is Robert Sockin, who's a senior global economist with Citigroup. He has extensive experience in both financial markets and economic policy. Prior to his current role, he was a senior economist at SPX Capital, covering the US and Canadian economies. He's also worked as an economist at UBS, a policy advisor at the US Treasury Department, started out his career researching global trade in the International Finance Division at the Federal Reserve Board of Governors. In addition to being cited in policy reports and academic research, Robert's work has been covered in major media outlets, including the Financial Times and Wall Street Journal. Robert received his bachelor's degree from Columbia University, and perhaps most important of all, his master's degree from NYU. So welcome, Robert. So with that, I'm going to hand it over to the panelists for their opening remarks. We're going to start with Aditya Bhave, followed by Tani and Robert. So Tani and Robert, you can turn your cameras off while Aditya has the screen. Thank you so much. Tani, if you could turn on your screen, and then the screen is yours.
The screen is mine. All right. Thank you so much. Yes. So just listening to Aditya, thanks for your comments. Unfortunately, I agree with a number of items that you have discussed, but I will try to be as contentious as possible. So I think the word that I have for this whole for the whole economic situation, the U.S. economic situation right now, the word of the day is uncertainty. The word of the year is uncertainty, and that's really driving all of the behavior. And this goes beyond, I think, and I think this is important to point out, beyond tariffs, right? This is not just a tariff. If only the tariff rates were stabilized, then the economic situation would be normalized. There's a lot of moving parts in terms of the national security priorities versus reindustrialization. Yes, tariffs have something to do with it, but that's not the only concern. Now, that being said, a lot of the economic effects directly are through tariffs. So let me explain a little bit, let me discuss a little bit in terms of the uncertainty themes. Obviously, the way I see it, and I think this is it rhymes a lot with what Aditya was saying, consumers are holding back, right? They're very cautious. They're concerned about labor markets. They're concerned about inflation, even more so than economists are concerned about inflation, which is interesting. If you look at the University of Michigan survey, for example, somewhere in the middle of the year, a couple months ago, consumers were expecting an inflation rate higher than they expected at any point during that 2022-2023 phase of inflation. So they were a little bit fighting the last war, really concerned about potential resurgence of inflation. And now, of course, with all the labor market chatter making the headlines, that I'm sure is weighing heavily on sentiment. So there, I think that's very much the case. Spending is very cautious right now. I will say, just to go into a little bit of detail on the balance sheets. The balance sheets. So I would view the consumer as being cautious, not as being on aggregate constrained. Now, of course, there's the distributional effect where certain shares of the population are indeed constrained by income constrained or liquidity constrained. But on aggregate, debt to income levels or debt to income ratios are about as low as they've been since 2012, barring some blips during the pandemic. Partly because debt got inflated away, household debt got inflated away during that high inflation period, and partly because of the stimulus. And we haven't gotten back to that very high level of inflation, high level of debt yet. We're still actually, on average, at low levels of household debt. And then even debt service ratios, which you'd expect to be very high, are relatively benign. They're lower than they were in 2019, despite the fact that that interest rates are so much higher than they were back in 2019. So I think those are really important points to make. And yes, there's that infamous or famous study from Moody's that says that the top 10% of consumers are doing 50% of the spending, right? And if you have that top, and essentially that top 10% is carrying a massive amount of the economy, or that's what's driving, the remaining spending of the economy practically. And if they're not, as long as they're not constrained, the economy can keep spending, or the economy can keep growing, at least at some level. And so, perhaps, obviously this is not comfortable for those toward the bottom of the income ladder, but on aggregate, there is that spending capacity there. There's a lot of choice involved in terms of not wanting to spend, and rightfully so. So then turning over to the businesses are in a very interesting and strange situation right now. So obviously, tariffs are hurting businesses. The uncertainty around tariffs and all the different policies are hurting businesses in terms of being able to make future plans, right? They are, they are not sure what to do, right? We're not supposed to invest in China, so we invest in Vietnam. Wait a minute, now Vietnam has higher tariffs than China, as does Japan and Korea for some reason, right? None of this really is something where you can make easy decisions as a business owner. Now, I will say, I'll do a mea culpa here. A couple months ago, we were talking about those profit margins. So we look at an interesting data series from the Federal Reserve, which looks at corporate profits, both of basically all companies other than sole proprietorships. It's a Federal Reserve line item, as a share of GDP. And that gives you a form of corporate profits, not just for public companies, which is relatively easy to find, but also for all that sort of mass number of private companies. And that number corporate profit margin has been incredibly high for several years, sort of done a secular shift from below 9% before the financial crisis to now above 10%, and since the pandemic, even higher than that. And I naively thought, well, clearly they're going to have to start to narrow their margins, these businesses, because they're going to have to eat some of the tariffs. I was looking at the consumer, thinking the consumer is going to push back. They're not going to accept prices. That continues to hold. But those profit margins, certainly for Q2, and at least for publicly traded companies, have continued to remain incredibly robust. So they're remaining at not just above recession levels, but actually very strong levels, sort of on an absolute basis. And I think that's really interesting. Companies are protecting their profit margins above all else right now. They're managing costs. They're being incredibly cautious about all sorts of investments. Leaving aside AI, right, which is the one area where every company will acknowledge putting extra money in. Everywhere else, there's a lot of talk about managing costs, being smart about costs, smart growth, sort of all those buzzwords like that. And what we're seeing is that companies have managed to somehow they've pulled this off, where they are seeing higher tariffs. And seeing higher prices, primarily because of tariffs, not passing all the growth and increase in prices onto consumers, and yet still managing to keep profit margins high. And not only that, they have not engaged in mass layoffs. So it's a pretty sweet spot that they're in, but it is obviously a very delicate situation, or a very narrow margin that they're walking through here. And for now, until now, what their game plan has been to not hire behind, generally speaking, not hire behind anybody that has left, not hire too many from the graduating class, sorry, seniors, and not able to, and being very cautious before going out and recruiting new people for other management positions. So that keeps a lid on additional costs, particularly labor costs, without actually engaging in layoffs. So there's that sort of frozen labor market story coming out, where there's not a lot of movement on the part of businesses to actually make major changes on the labor market. So far, they are holding the line ahead of, away from major layoffs, aside from these things where they lay off a bunch of people in one department in order to hire more people in the AI region, right? So aside from that, we haven't seen, reorganizations. Aside from that, we haven't seen an enormous amount of layoffs sort of on the aggregate level. So that's the way we've been. Things have transpired until now. I think the question going forward is, what happens now? So we also don't have a recession forecast, and there's a few ways in which we can see we can avoid a recession. One is that the end state, sort of the Wonderland scenario is somehow we wind up at a better tariff level, or at a better tariff level, at a more conciliatory geopolitical situation than currently we're expecting, right? And that could, at this point, the expectations are quite low. The bar to this is relatively low. Right now, people are assuming that we're at 15% as a baseline, plus, depending on the country. So the expectations there are set very low. There's possibility to improve on that. So that's a little bit the Wonderland scenario. There's a couple other ways in which I think you avoid the path out of a recession, away from a recession. Another is that the uncertainty reduces. So we did have that initial April 2nd shock. It got pulled back. And then since then, the tariff percentages, some of them have been high, some of them have been alarming, but they have perhaps been more in line with expectations after that initial bump, right? And then the other possibility is that people are simply become accustomed to a more volatile world. And we've been seeing that where each additional bump, each additional tariff change and tariff increase has had more of a shrug from the market perspective. Right? The markets have reacted with a shrug over the last several months of tariff news. And there, I think that's one of these situations where human capacity to adapt is incredibly strong. Does it mean that we're going to be in a boom situation? Most likely not. But there will be perhaps a nearer term situation where businesses say, okay, well, these are the rules of the road. I guess I'm pretty safe if I invest domestically. I have certain capacities to expand domestically. Let's go ahead and do those things and really forge ahead with certain things. Or if I have clients abroad, I commit more abroad instead of trying to export through various countries. Regional production. So those are a couple of the different ways. One is, and perhaps, and I think the one that I am settling toward is that companies are going to adapt to this. There's also the entire the entire region of AI to start thinking about. Obviously, there's a whole different, there are different companies, there could be different industries, but on an aggregate level, there's a lot of investment still happening, a lot of investment and a lot of actual activity still taking place in the AI sphere, not just with, AI companies doing, sort of at the forefront of AI, but sort of the larger companies that need to now adapt to AI, to the existence of AI. And that requires investment, certain levels of investment, certain reorientation. And then let me also close with the Fed. I don't have anything particularly different than Aditya. We do have 6 cuts, so 150 basis points of cuts by the end of next year. That gets us close to, the expectation of the neutral rate by year end. It gets us close to what Treasury Secretary Bessent has stated as what he expects the neutral rate should be. I think, there's clearly going to be a change in regime next year at the Fed. However, it's not necessarily the case that that regime is entirely interested in creating an inflationary environment ahead of the midterm elections. So I think a moderate but not insignificant easing path makes a great deal of sense because of the weakness of the labor market. And, I think that 2%, let's not fetishize that 2% so much, right? That 2% inflation target is desirable, but a low and stable, a strong, robust labor market is as desirable, if not more so. Once you start thinking about sort of these structural problems, right now we have the highest, an extremely high percentage of unemployed people being unemployed for 27 weeks or longer. You don't want that. That creates real structural problems, and you want to actually avoid that because you're just creating a lot of you're destroying a lot of human capital in that way. So let me stop with that, and I will hand it back to Venky.
Great. Thank you so much, Tani. Robert, take it away. All yours.
Fantastic. Thank you. And thank you for having me speak at this forum. It's an honor to be here. And I think hearing all of the comments, I imagine I'm probably on the most bearish side of the 3 panelists, but not drastically so. We also don't have a US recession call in our forecast, but maybe have a period of a larger slowdown in growth and maybe a larger deterioration in the labor market than my other panelists have expressed. But maybe for the closing sort of opening remarks, I can give a bit of a global flavor on top of the US story to kind of add some additional dynamics to what we've been talking about. And I've broken it down into sort of 5 key points. The first one is just as we've seen in the US, we have seen more broadly a story of global resilience to start this year. The global economy typically grows at 3% per year. Over the last few years, we've grown at about 2.8 to 9% a year. So just a notch or so below the historical average. And in the first half of this year, the global economy grew at about 2.5%. And so this US resilience story that you've heard, you very much have seen that at the global level. That global growth slowed a bit from the pace of the last few years, but not nearly as much as we had been expecting. And even going into the third quarter, many indicators continue to show a fairly resilient picture. If you look at the global purchasing manager indexes, which are some of the indicators we track most closely for the global economy, if you look at manufacturing and services, you see readings that in the manufacturing sector are close to, and even in the latest reading, slightly above what we've seen in the last few years. And in the services sector, also slightly above where we've been the last few years. So all in all, even though we've been expecting a slowdown from the tariffs in the US and more broadly around the world, we've yet to really see that materialize at a large scale so far this year. The second theme, though, is that while the first one is global resilience, the second one is that we do expect that the tariffs are going to eat more into activity, but they are percolating through the economy slowly. And one example is one thing that has really driven the resilience that we've seen around the world for much of this year, as the tariffs have been threatened, paused, stopped, started, you have seen US consumers and businesses front load a lot of spending to get ahead of these tariffs. If you look from October of last year to March of this year, you saw imports into the US rise by about 30%. And if you look around the world, you saw clearly strong exports into the US from the European Union, various economies in East Asia. Exports in those economies were running well above trend. So this front-loading story really supported global growth around the world by spurring export activity. And you also saw it domestically in the US as well. For example, at times seeing strong auto sales as consumers also tried to purchase goods that have a lot of foreign content in them. And so broadly speaking, this front-loading story we think has been an important part of why we've seen a lot of resilience around the world. But just as imports were up 30% from October to March of this year in the US, they fell about 30% in Q2. And so that front-loading activity looked to have largely played through in the second quarter. And one mechanism that we think is going to weigh on global growth and the US as well is a lot of that front loading of activity that we saw earlier this year is going to have to be paid back later this year. And so, for example, you should expect, I think, a period of very weak imports into the US because, as an example, if you bought an iPhone in February that you were planning to buy in October, you no longer need to buy it in October. So we expect that you're going to get payback for this spending. That's going to weigh on global growth around the world through weaker exports. Now, that being said, it's been very hard to time these effects. Even though you saw imports fall sharply in Q2 in the US, you saw them bounce back up in July, which was a bit puzzling to us at first. But I think the reason is even higher tariffs were threatened during the summer. And so even though some tariffs were already on, products also had higher tariffs that were threatened. It's been very hard to predict where tariffs are going to go. And so you're still getting some front loading of activity, even though tariffs have been put on already. And so it's been difficult to time how much the tariffs are playing through, but we are seeing increasing signs that they are percolating, but just more slowly than we would have thought. So that's one key channel that we expect growth to be weaker in the back half, is this front loading of purchases is going to have to be paid back. The second channel that we think is going to weigh on US and global growth is as the tariffs get pushed more onto US consumers, that's going to weigh on US real incomes and US spending power, which again will lead to less domestic consumption, also less imports. And you're starting to see that percolate slowly as well. If you look at the latest hard inflation data, we estimate that about 30 to 40% of the tariffs are getting passed on to the consumer at this stage. If you went back a few months ago, it would have been much closer to zero. So you are starting to see it grow, but it's moving along relatively slowly. The tariffs, generally speaking, can be divided along three margins of adjustment. One, exporters can absorb it into their margins by lowering their prices, so offsetting the cost of the tariffs. It can be absorbed into importer margins, or it can go on to the US consumer. And I mentioned 30 to 40% is our estimate of how much is getting passed to the consumer. On that first margin of adjustment, the exporters, we find very little evidence that exporters to any broad sense are absorbing these tariffs at all. You've had some small stories or relatively small stories like Japanese auto exporters, for example, lowered their prices to the US significantly as the tariffs came on. But when you look at aggregate import prices into the US, you really don't see much absorption on the part of exporters. So that means if 30 to 40% is falling on the US consumer, 60 to 70 is falling on the US importers. And to us, that just seems like an unsustainable strategy. And I think as we go forward, the balance is probably going to be more something like 60 to 70% will be on the US consumer. The next biggest bucket will be the US importer. And then companies will try and get exporters to absorb at least a small share of the tariffs. But over time, more and more is migrating into US consumer prices. And we just expect those pressures to grow going forward. So again, that's an example of the tariffs are starting to play through more in the ways that we expect, but it's just moving much more slowly than we would have thought. I think there's a lot of reasons that things are moving slowly. I speak to corporates all around the world, and one of the biggest messages I hear is that it's been very challenging to know where the tariffs are going to land and which products are going to have tariffs in which countries. And companies have been very hesitant to put through those price increases until they have a better sense of what the landscape looks like. And so they might be eating it in their margins temporarily, but eventually you're going to have to pass more on. There's also seasonal elements to this. For example, I've spoken to a few apparel companies, and they tend to price things seasonally. And in their spring lines, there was a lot of uncertainty and confusion about where the tariffs are going to end up. But now that it looks like tariffs are going to end up at a more durably high level, they're going to have to pass more on, I think, in their fall lines. A third reason is this importing story that I mentioned. Companies were able to build up inventories that they could run through to avoid putting on those price increases. But these are all mechanisms that are just delaying the pass-through process in our view, rather than suggesting that more is not to come. So when I put that together with the trade data and the inflation data, I think it's been hard to time, but the tariffs are going to continue to put more pressure on the economy as we go forward. The third category is, I think high tariffs are here to stay for the foreseeable future, which again fits into that second bucket, which is companies are going to have to pass on, I think, more of these price increases given where tariffs are landing. If you went back to the beginning of the year, we were thinking tariffs would end up at a much lower level, that most of these tariffs would be used as threats. I think it's fair to say that most economists were in a similar spot. But we have been consistently surprised with how aggressive the Trump administration has been with its tariff policy. Our estimate is that tariffs are at about 18%, the effective tariff rate on U.S. imports at the moment. You may see some other estimates around. There's some guesswork that goes into making that number, but give or take, we are somewhere a notch or two below 20% on the effective tariff rate. That's up from 2.5% from when President Trump took office. The actual collected tariff rate is a fair amount lower. If you look at the duties that are coming in over imports, it's closer to 10 or 11%. But we do think that's going to grow over time and closer to the stated rate as implementation issues are figured out, as lags in collection are processed. And so by and large, we're going to be at a fairly high tariff rate going forward. I think there could be additional sectoral tariffs that come into play. The administration has talked about things like tariffs on electronics, pharmaceuticals. We see no reason to think that those aren't forthcoming. That could add another 4 or 5 percentage points to the effective tariff rate, which means that you could have a stated tariff rate that's over 20% in the near future. And then it depends on where these trade deals land, but they are landing at higher levels than we would have thought. I think good examples are the EU and Japan, where you had a 15% reciprocal tariff rate, again, higher than we were expecting. And some countries may end up higher than that. And so I think when all the dust settles, we're looking at an effective tariff rate no lower than 15% and maybe somewhere closer to 20 for the foreseeable future. And that's a challenging level. And again, much higher than I think anyone would have thought when the year started. So that's the third bucket, high tariffs for the foreseeable future. And that fits into, I think, more of these price increases are going to have to get passed on to the consumer. The fourth bucket is on central banks. And just quickly, for the rest of the world, the tariffs, the primary channel that they act through is we are cutting off a large export market for other economies. And so it is a negative demand shock for the rest of the world. So while it's a stagflationary shock for the US, it's a negative demand shock for the rest of the world. And so the US would have higher inflation and lower growth, while the rest of the world would have lower growth and lower inflation due to the tariffs. So everybody has lower growth. The biggest hits in the US, but only the US is dealing with the challenges of higher inflation. That's reinforced by our oil price call, where we think oil is going to fall and stay durably in the low $60 a barrel range in terms of Brent oil for the foreseeable future. So that's another sort of disinflationary tailwind on top of that lower global growth. And so for other central banks, we see no major central bank hiking rates through the end of the year. And we see the majority of them cutting at least a little bit at some point this year, and many of them next year as well. Now, the timing there, again, has been very challenging. I think it's because, as we said, the effects of the tariffs have largely been theoretical at this point. They're percolating slowly. So other central banks around the world have been fairly cautious in this environment. But I do think as more of those effects play through, we will see central banks around the world again lean into rate cuts. And again, if it's not in the back part of this year, in 2026. But broadly speaking, this will be a global central bank easing cycle that will continue. For the Fed as well, it's already been discussed. I think for us as well, I think they'll focus more on the growth side of their mandate. And to us, that means 2 to 3 cuts this year. I think the weak labor market data that we've seen so far, I don't think puts them into the space where they'd be cutting 50 at a meeting. But I think 3 rate cuts or 2 is a very close call. Depends how well growth holds up in this environment. We think in the back half of this year, the U.S. economy will grow below 1%. And in that case, I think it's a fairly close call of what they do, but then continuing to cut next year as well. So bottom line, even the Fed is cutting in this environment. The Fed has the toughest job of all. Other central banks, it's an easier landscape of what they should do. And then the final point to close is I see risks on both sides of this forecast. On the one hand, as I mentioned, tariffs are landing at a much higher level than I would have thought. And when things tend to change in the economy, they tend to change fairly rapidly. In our forecast, we have the unemployment rate rising to the high fours. That's kind of an immaculate forecast because when the unemployment rate starts to rise by that much, it tends to keep going. And you see as well, we have growth below 1%. When growth tends to fall to low levels, it tends to keep falling. So again, it is a challenging environment to call, but where tariffs are landing and the challenges there, I still think put some downside risk. But to the upside, this has been an amazingly flexible and resilient U.S. and global economy. If you go back the last few years, we were calling for a recession in the U.S. for much of that period. Not only did that not materialize, but the U.S. economy grew quite robustly. The U.S. consumer was the backbone of that recovery. If you compare developed markets around the world, the U.S. was the strongest performer, and it was really due to the resilience of the U.S. consumer. And the U.S. consumer, while I think has a softer backdrop than it had the last few years, a softer labor market, softer in that it's, consumers have drained all of the savings they built up during the pandemic. Those excess savings that they built up have been drained at this point. Lower income consumers, as mentioned, show some strain, but still, overall, in aggregate, balance sheets look quite healthy for U.S. consumers. And I have discounted that strength in the past, only to be surprised to the upside. So given what we've seen over the last few years, I don't want to discount the possibility that we can continue to see a very resilient U.S. And global story going forward. So fairly balanced risks around that forecast.
Wonderful. Thank you so much. Aditya and Tani, if you could turn your cameras on, I think we can move to the Q&A section. So there's a lot of questions, and I'm not sure how many of them we'll be able to, and some of them are probably deserve separate sessions in and of itself. So I'm going to try and group some of them together and go from there. So I'll start off with something which I think all three of you brought up in various ways. The labor market is kind of is perhaps the part where there's perhaps a lot of uncertainty. So I'm going to ask a version of two questions that were posed in the Q&A panel. One talks about the recent large revisions we've seen, and Aditya, in your talk, you mentioned the QCEW revisions today. But I think more broadly, we've seen bigger revisions and bigger negative surprises. So my question is, one is we could get into a discussion of where those revisions came from and why, but what perhaps is more useful is to explore whether there is a risk that we are underestimating the weakness in the labor market today. Are we setting up a stage where we are actually, the labor market's a lot softer than what it looks like, and we'll learn this over time as more data and revisions come in? And do you see that as a significant risk given recent trends of revision? So that's kind of one question. The second, and perhaps somewhat more speculative question, has to do with your views about the quality of labor market data going forward. And I know that's been something that's been talked about a lot and it's been speculated a lot. It's hard to say what's going to happen, but to the extent that, the data coming out of the BLS is potentially at risk of declining in quality, are there alternative measures or indicators that you or your teams look at as a way of building up a more complete and picture of the labor market? And we'll go in the same order, Aditya, Tani, and Robert. Again, this is kind of a somewhat broader question. I'd say keep your responses perhaps somewhat tight and focused, and then we can more as we go along.
Yeah. So I would just hop on to that last comment in terms of the positivity of the revision, in the sense that, well, consumers, yes, they've been cautious, but the fact that there have been fewer people employed apparently than thought, that means the consumption is all that much stronger or all that much more positive. That there's this ability for consumers to continue to spend despite apparently a weaker labor market or fewer people employed than previously expected. And I would highlight, and maybe this is something I'll just sort of plant a flag here. I think there's a very interesting small business story here where there's a lot of they're much more vulnerable to being price takers, being not able to optimize their tariff responses, things like that. So I think that's an important point in where the weakness could lie, and maybe there's some more concern on the business side going forward. We haven't seen an increase in bankruptcies among small firms, but something to be cautious about. In terms of the BLS, I think right now, the commissioner is the commissioner. I'm sure she was doing a great job, but there are technicians at the lower levels of the BLS doing a lot of the dirty work, and many of those people are still gainfully employed. So I think in the near term, I'm not worried about the BLS. In the longer term, yes, there is really this question of what do? You need to supplement in some ways. And I'll be honest, we have not yet materially addressed it besides in our usual ways where we look at a variety of data sources, but we have not really yet grappled with the implication of perhaps we need to do the checks on the data the way we do it for, EM countries, right?
Maybe I can add all great comments. Maybe I can add 2 points. One, I completely agree on the U.S. data. One thing I'm watching closely, as mentioned, there's a head of these institutions, but the real work is done by career staff, statisticians, economists, and I think if the data were really being challenged in a political way, you would see widespread resignations at these institutions, and you really have not seen that on the economic side. So, and the fact that we're still getting fairly soft data despite the political outcry from several weeks ago. So we're still holding that the data will stay reliable. Watching those things that I mentioned closely. And I think that most likely you'll get a revamping of the way some of these surveys are done, maybe trying to improve the response rate on the first month for these surveys. But I think it's important for markets and investors and the public that the data stay reliable. And I think politicians know that as well. The second just quick point is a couple of things have come up about the labor market. And I just want to mention that I think it ties a lot of things together. It's hard to judge where the labor market is at the moment. Aditya mentioned because labor supply is weakening, labor demand is weakening. One thing that we've used to kind of describe it, which I think is a good description, is it's a low churn labor market, and that you've seen, as mentioned, very low layoffs, as Tani mentioned. But soft hiring rates, low quit rates. So it does feel to me like a labor market that's quite vulnerable to a shock, given that we've been in this low churn environment for a while. That's hurting certain pockets of the labor market, as Tani mentioned. Softness on hiring of people coming out of school because people aren't leaving their jobs. People aren't getting laid off. So it does feel like that's still a good description of the labor market. And maybe some of these revisions that we've seen or softer hiring numbers add some more vulnerability on top of that. So, but I think that's a good description of what a lot of us have said about various qualities of the labor market at the moment.
Great. So I want to kind of switch gears and talk a little bit about inflation, which again, something all three of you mentioned in various ways. So there's one aspect which is about the near-term impact of the near to medium-term impact of tariffs. But I want to kind of also get your thoughts on somewhat the slightly longer term inflation outlook. And one concern there, which has been talked about quite a bit, is whether the degree of independence that the Fed has enjoyed is going to change materially, and how that's going to shape inflation, either in levels or in volatility. And so you see some signs of that in commodity markets, in prices in gold. You see some signs of that in the steepening of the yield curve. So you see some signals that markets are worried about some of these concerns. And so I just wanted to get your thoughts on how you're thinking about it and what kind of implications you think that's going to have for both markets and perhaps the economy more broadly. And just to mix things up, maybe we'll go in a different order. We'll go reverse. We'll give Robert, Tani, and then Aditya in that order. Yeah.
Oh, great. Yeah, I just spoke last, so now I feel bad because I had just on the last question. But I'll say some quick comments, which is one, Fed independence has come up in a few points in this conversation. I'm more worried about it than I would have been 6 months ago, let's say. But at the same time, I think this exact issue, and this also came up earlier, that the administration, I think, is being very careful because they know if they undermine the Fed's independence, they push it too far, you're going to see longer-term inflation expectations move up sharply. You'll see the 10-year U.S. Treasury go above 5% or maybe more. And so it's really a difficult tightrope to walk. And so at the end of the day, I think when I look at the people who are being talked about for Fed chair, I think they know the importance of the Fed independence as an institution. And I still think it, despite all of the public criticism and rhetoric, the Fed will remain independent at the end of the day, in part because of these exact challenges that, and you saw a bit of that in April when the administration floated the idea of firing the Fed chair. You saw markets react very poorly and the administration walked that back. So, I think the Fed will move, the board, as mentioned before, probably moving in a more dovish composition. And as we have discussed, there's lots of reasons to think you should cut rates in this environment. Maybe that means as you get to more marginal decisions, it leans in a slightly more dovish direction. But I still hold at the end of the day, the Fed will remain independent and committed to its price stability and stable labor market growth. I'll stop there. I'll answer that part. I'll leave the other components and also comments on that for my other panelists.
So yeah, I mean, I'm afraid I would say essentially the exact same thing. I don't envy Powell. Well, I'll take his job. That's fine. But I don't particularly envy his current situation. However, we and I don't think this is particularly healthy for markets. But it seems to me we've been in some kind of situation like this before with Burns under Nixon, and this I'm not 100% sure if I have my facts straight, but under, I think Volcker resigned earlier than he would have liked to under Reagan, and he never really got inflation down to, now they didn't talk about 2% the way we talk about 2% now, but he still had some ways to go. And that took another several years before inflation really recovered from that 1970s, 80s situation. So perhaps we're in a light version of that, in terms of, yes, inflation is higher. We're going to cut. And so it's going to not hit 2%, as far as I can tell, barring crazy things in the near future. But we'll get them next time, maybe, in terms of the inflation, in terms of getting inflation back down to that actual 2%. I think I'm worried. It could about the Fed independence, but I don't think it's an insurmountable situation at the moment. And a lot depends on that sort of the inability, and presumably this will always continue, inability of the administration to tame the bond market. Yeah, I think that's. I think you said something about the steepening of the yield curve. To me, that's a fiscal question. So, but we'll talk about that later, maybe.
Perfect segue into my fiscal question. So this is like, as I joke about this, I'm contractually obligated to talk about the deficit for a certain period of time. So the way I want to kind of frame this question is, is this again, a replay of something we've seen at several points in U.S. Or in recent history, where the market there's a lot of hand wringing about the deficit for a few weeks or a few months, and then we just forget about it and life goes on. Is this really an inflection point where this is going to be a much more significant issue, perhaps not just for interest rates and asset prices, but also have macroeconomic consequences. And Tani, since you mentioned the word fiscal first, I'm going to give you the first chance to respond, followed by Aditya and then Robert.
Okay, yeah. I mean, I think this is a very central question. I think the markets have been behaving a little bit differently. This is obviously not just a fiscal situation, despite my earlier comment, but certainly including the fiscal situation in terms of just how the yield curve, how the yields have behaved with respect to shocks to the market. More concern about the U.S. economy, not clearly because of the fiscal situation, not just the dollars in debt, but the incapability of actually making a sensible budget and making hard decisions. And where that risk is increasing is the fact that people are now also looking at alternatives, perhaps given, and this harks back more to the Ukraine crisis than anything else, perhaps given the US's interest in sanctions and freezing bank accounts and things like that, we should perhaps diversify our portfolios to gold, crypto, stablecoin, whatever, right? And now none of these are a dollar replacement, but they'll do in a pinch. And I think the fact that there's less demand for yields for long-term assets from the U.S. As well as real lack of solutions. I think these are all serious concerns. Now, I do think that we are not quite at the situation of an actual crisis. We'll probably have to be several points more closer to an actual crisis to be taking this seriously. This will probably be another temporary hand-wringing exercise. But I think we're getting closer to that time period where there are fewer people there to just opportunistically pick up the long end of the yield, as Aditya was saying. So I think moderately worried, but in a medium term way. Right, not necessarily over the next. Right now, let's say I think the 10 to 20 spread is somewhat higher than it's been, but I think it was something like above 70 basis points. That spread from 10 to 30, that's been above 70 basis points a third of the time, a third of its existence. It's not horrible right now, right? But it might come in, but there's a problem brewing there. I don't think it comes to a head yet.
Yeah, all great comments. Let me just add a thought or two. Agree with everything that was said, and just wanted to also mention I really like Aditya's point that on the tariffs, I didn't mention the court cases when I was kind of going through the high tariff scenario, because when we look at it effectively, the executive has an enormous amount of tariff authority to effectively do largely what the administration wants to do on tariffs, give or take a little bit. It doesn't change the effective tariff rate all that much. They can just do a range of studies on large countries and then put on tariffs eventually. So we haven't really changed our view based on that. And that does feed into the fiscal discussion, because as mentioned, we're getting probably something around 1% of GDP in tariff revenue a year. To give some numbers, we think fiscal deficits per year for the foreseeable future are going to be roughly 6% of GDP. That includes the tariff revenue. That includes the big, beautiful bill that was passed. So if you don't have that tariff revenue, you're up at something closer to 7. And then some of the other issues that were mentioned about the tax cuts sunsetting, as we just learned from the big, beautiful bill, Politicians do not like to let tax cuts sunset. They just extended the 2017 Trump tax cuts that were supposed to expire in that bill. So, if those get extended, that's higher deficit still. If those spending cuts get pushed out, those are higher deficits still. So it's easier to get to bigger numbers, which is why most likely, whoever's in office and then several years from now, those tariffs probably stay on, given the fiscal situation. Now, we've written a few reports about this exact issue. How much debt in the U.S. is too much, when you hit challenges, and it echoes exactly these factors, which is, the U.S. has a lot of special qualities that other countries don't have. We have the world's reserve currency, world's deepest liquid capital markets, world's biggest economy. And so it's really hard to time or predict when this would be a material issue. And we're we can't rule out any type of crisis, but that doesn't mean it's not creating, even though that seems unlikely, doesn't mean it's not creating challenges where you're going to potentially get more and more pressure on longer term bond yields through term premium because of this high debt and very high issuance that we have as a result of it. At some point that probably gets to such a challenging level that maybe politicians pay attention once the market pressures get so high. But it's been really hard to predict when those would come. I mean, I remember when I was at Treasury 8 years ago, we were, worried about who's going to buy government debt back then. I mean, these are always issues that come up. Who's going to buy the debt? And they're always buyers. And it seems like, not alarming prices. And so even as some of the buyers around the world that have historically held a lot of our debt, China, for example, is the biggest one that comes up often. They've been holding less and less as a share of our debt over time. But private foreign demand has been quite solid over that period that China's demand has been falling. So overall, it's just a very hard picture to get your head around. It's a worrying picture. And at some point, it's going to be an even bigger issue. And in the near term, it's putting some amount of upward pressure on longer term bond yields that we wouldn't have otherwise if our fiscal house was more in order.
Great. Thank you so much. So my next question, and perhaps or maybe next set of questions are about AI, and I'm going to kind of break it down into 2 or 3 themes. I'll present all of them, and then you guys in your responses can focus on whichever one you find most interesting or relevant to talk about. Right. So there is one which is about AI and as an engine of productivity growth and a kind of a positive boost. The second is about AI as a major disruptor in the labor market. For example, there's some evidence that some of the activity in the labor market or the weakness in the labor market, especially at the entry level, is perhaps at least significantly due to AI. Right. And how do you see that? So one question is, how do you see that playing out, or how is that going to shape up, in the quarters or years to come? The third theme is AI and the corporate sector, or AI and businesses. To the extent that this is going to be a large disruptive kind of shock to the economy, how do you see the U.S. corporate sector or the U.S. business sector positioned, to deal with that? Is this about, creating massive winners and losers? Is it going to be a rising tide that kind of lifts all boats, or is it going to be major investment kind of boost more than anything else? And how do you see that playing out on the business side of things? So I've kind of laid out 3 broad themes. We'll go again, in the reverse order. We'll go Robert first, Tani, and Aditya. And again, you don't have to talk about all of them. Pick whichever theme that you think has the most strikes you as the most interesting or underappreciated.
Oh, great! This is a great set of issues. I think it's really nice to talk about because we're talking about some of the challenges from tariffs, and but in the background, as has been mentioned earlier, we do have this AI story, which in many ways has been separate from that. Let me make a few quick points, and then I'll pass to other folks. On the productivity side, so far we have seen no evidence in the aggregate sort of productivity data that AI is boosting U.S. productivity today. Maybe there's some challenges with measurement. But when we compare over a long history, you've seen somewhat of a rebound in productivity in some sectors of late, but we think that's largely sort of a cyclical rebound rather than a structural change due to AI. So far, we're not seeing it in the figures for the aggregate economy, but we do think it's going to be quite transformational. And sort of our best guess, by assessing all of the surveys and literature we could find, is that in a few years' time, for an extended period, it could boost U.S. productivity growth by around 1 percentage point a year, which is quite transformational. But again, we don't think we're there yet, and we think it's still a few years down the road. On the labor market, this is an area I find very challenging. When I look at kind of surveys or speak with companies about what it's going to do for employment, if you look historically, most major technological changes tend to create more jobs than they destroy. Is AI different? It has me concerned. It feels like it could be a bit different. And when I talk with companies, I said, look at surveys, people are able to identify the job cuts, and very few people are able to identify the job gains. And it does give me pause that this could be different than past technological changes. Now, that being said, it may be that figuring out what new industries pop up and what new jobs come is much harder than figuring out what you can replace with AI. And so maybe that's usually the case. But it does give me pause that these will create employment challenges. And you're already seeing some of that in the labor market, as you mentioned. There was a study out of Stanford about how AI is depressing the job openings for labor market for younger cohorts. You're seeing coders have a very hard time in this labor market. So it's bubbling up in maybe certain pockets, but I am worried about the employment effects and unsure what the overall effect will be. And then the third thing on the corporate side, quickly, when you look at how which countries are the most well-placed for the AI transformation, it really is the US is front and center. The US has roughly half of the world's data centers by the last count I saw. It has 10 times more data centers than the next highest country. Most of the major innovative companies in the space are in the US. And we're seeing markets start to pay attention to that, moving from the sort of AI enablers to who are the AI adopters, who's able to run with this technology. So there probably will be winners and losers within the spaces of who can adopt it and run with it. But I think the U.S. is best placed around the world to be sort of the leader in the AI space and reap the most benefits from it.
Yeah, so let me just start with my first point, which is that my daughter, who is 10 years old, probably has as much experience with AI as I do, and perhaps a little bit more. I mean, she's been working with AI for 2 years. I've been working with it, 2 years in a couple of months, right? I mean, that's kind of so I'm not worried about the youth. I may be worried about a 23-year-old trying to find a job market in a totally different environment. And I think, but I'm not worried about the general trend. I think what's happening right now, if you look at youth unemployment, I think that companies at the moment are using AI as a smokescreen / cost-cutting tool. That's the general company. I'm not talking about whatever OpenAI or Google or whoever, but your general company is going, I need to cut costs because these tariffs are killing me, price increases are killing me. I'm going to do more with less. I'm going to hire fewer people behind this person and try to get my people to just use these AI tools to plug the gaps and do two people's work. That, I think, is colliding right now with the AI wave of the general AI wave that's happening with businesses that are not specifically AI, that are saying, now we need to get on board the AI bus, right? That's happening at the same time. And there's a bit of a confusion, I think, that people are merging those two trends together, and they're actually two separate trends. I think we'll see AI being used in a more expansive, positive direction, or we would be seeing it if we weren't in a sort of slow growth, struggling kind of environment. And so we'll see that. I guess I'm the big optimist right now, but I think I'm very positive about where the AI goes. Now, I would not want to be in software development at the moment. There's certain industries, certain companies within certain industries that are going to be particularly hard hit. I think right now there's a lot of figuring out of how does it, how do you restructure your company such that it is structured in an AI optimized way? And the big danger for the legacy companies is they are not necessarily structured in a way that helps them use AI most efficiently. They could be new companies coming up that are able to do that better, or the legacy companies, the ones that are able to absorb it and optimize it the fastest, will be the winners. So again, it's a winners and losers, as Robert said before, and so so that's my general view. Of course, it'll take a long time to get to that seeing the productivity everywhere, but in the data, right? Seeing it actually in the data situation. That'll take time. And that might be completely independent of what goes kablooey in the markets, right? There might be a bubble that bursts, but there is a fundamental value there.
Wonderful, thank you. So I want to ask for my kind of final question, which is not so much about economics or about your economic outlook. There are a lot of students in the audience, and all of them and all of us look to you guys as role models. You've had careers and you've kind of straddled various capacities, and so from your vantage point, or from the vantage of your experience, I was hoping I could bug you guys for a few words of advice for our students, especially those who are graduating into this somewhat uncertain environment, and what perhaps they should be focused on both in the near term, but perhaps more importantly over the course of their careers. What sets them up for success and stuff like. So let's go Aditya, Tani, and then Robert.
Yeah, I'll just keep it simple. I mean, when I'm interviewing people for a position, for example, you can really understand who is a, let's say, not a fit, but who is thinking or enthusiastic and thoughtful about the topic. And I think the ultimate, and this is just stolen from somebody else, and I think ultimately the happiest people, or the most satisfied people at work, are the people that are at the intersection of something they like, something they're good at, and something that is needed. And that's it. Like you triangulate there and you figure something out in there, and that's kind of most people that are content with their work and relatively successful are in there somewhere.
Yeah, great. All great comments. May I say three quick related things which have been partially mentioned. One is that I meet a lot of people that have a very set view of not just what they want to do, but where they want to work and what the job is. And my career has been a variety of opportunities that arose that I didn't expect. I thought I would work in government for most of my life, and I got an opportunity to work at a bank, and obviously I'm here now. So that changed my life in many ways, and was an opportunity that I wasn't looking for or expected, and so I kind of a windy path. But I meet a lot of people that say I have to work at this company or this job, and I think just being open to various opportunities and what they might bring. Related to that, as the second point, which was mentioned, is I think you have to be passionate about what you do and love the work, and that's really going to show through and lead to success. I've worked at a lot of different places, but the through line has always been it's been economic roles. They've been all different places, but it's been analyzing the economy, which I love to do. And so I think that sets you up for success when you're passionate about what you do, regardless of the space it's in. And then the third thing that's related to that is, again, it's kind of similar to the first one about not being just committed to one particular thing, is be open to opportunities and see where they take you. That was one piece of advice I got early in my career, that following the path that everyone else follows doesn't always lead to the most success, and be open to windy routes to get to where you want to go. I know people, for example, who were geopolitical analysts or country analysts, never thought they'd work in the private sector, and then they've gotten picked up for various private sector roles that they're very successful at. And so again, just being open to opportunities and what they might bring.
Wonderful. I think that's a great note to conclude. So on behalf of everybody here, I want to extend our many thanks to our distinguished panelists for an excellent session. You've given us a lot to think about and process over the next few days. We will post a video of today's program on the center's website in a few days, so keep an eye out for that. We also hope to see you all again at upcoming events. And with that, once again, expressing our gratitude to our panelists, I want to bring this to a close. Thanks again, everyone.